Hi, let's take a moment to give ourselves some perspective on what we've learned in this class so far. If you recall, financial accounting is an information system in which we analyze, record, also known as journalize, and summarize, also known as post, business transactions, and then we report them on financial reports called financial statements. Those financial statements help people outside the business, such as investors and creditors, make decisions about the business. In Chapter 1, we learned how to prepare the financial statements, and in Chapter 2, we learned how to record transactions to get those transactions onto the financial statements. But we only learned transactions that affected the balance sheet, which were primarily financing and investing activities. In this chapter, we will learn how to record the day-to-day activities of running a business, and we call those operating activities. So let's get out our Chapter 3 summary notes, and we will use them to guide this mini lecture. Chapter 3 is about when and how we record operating activities. So let's take a look at our notes. Operating activities are the day-to-day functions involved in running a business. Unlike investing and financing activities that occur infrequently and typically produce long-lasting effects, operating activities occur regularly and often have a shorter duration of effect. Operating activities include buying goods and services from suppliers, paying cash to suppliers and/or employees, selling goods and services to customers, and collecting cash from customers. This is what's known as the operating cycle. Operating activities are the primary source of our revenues and expenses and helps us determine whether a company earns a profit or incurs a loss. So let's review this income statement. We learned how to prepare this in Chapter 1, but it's time for a review. The income statement is recorded in this left box. First, we have our heading, the name of the company, the name of the statement, and then the time period covered. This statement is for the month ended September 30th, 2018. Then we put the heading revenues, and we list our revenues from greatest to least and subtotal. Then we put our heading expenses, and then we list our expenses again from greatest to least, and we subtotal. Then we employ our formula, revenues minus expenses equals our net income. Now I'm going to flip the page for a moment to the next page just to review the definition of revenues, and then we'll come back to the income statement. Revenues are the amounts a business charges its customers when it provides goods or services. A revenue is recorded and reported when the company fulfills its promise to transfer control of a good or service. We say when the revenue is earned. And the revenue is earned by providing a good or service to a customer. And it's recorded regardless of when the company is paid, regardless of whether the customer actually pays the company. Revenue generated during the period is reported in the first section of the income statement. So let's go back. So on page 1, the revenues that we see listed here for sales and services reflect amounts earned just for the month of September. We use the term sales revenue when we sell products or goods. We use the term service revenue when we earn money by providing services. So the $9,000 that we see as sales revenue comes from selling apps and delivering those apps to customers in September. Service revenue of $3,000 is earned from providing services, delivering them in September. So we record revenues when goods or services are delivered, when we satisfy whatever performance obligation is in the contract. Now let's take a look at our expenses. I'm going to flip to page 2 again. And expenses are the costs of operating the business that are necessary to help us earn the revenue. They are incurred to generate revenues in the period covered by that income statement. Expenses are reported when the company uses something, such as supplies for providing services or the efforts of its employees. This word incur means to receive the benefit of a cost. We see that word right here. To incur a cost is to receive the benefit of that cost when it receives the labor of its employees or the utilities in the process of earning the revenue. Sometimes it receives the benefit of a cost by using up an asset, such as supplies or insurance that is paid for. But again, let's flip back to page 1. All of the expenses that we see here deal with costs that we receive the benefit of in September. So the September salaries and wages expense of $5,000 were for wages done for work by your employees just for the month of September. The rent expense of $2,500 is simply for rent in September only. $1,600 in utilities expense is utilities received just for the month of September. Insurance expense is insurance covered just for the month of September. In other words, the month that's reported on the third line of our heading here. So our income statement takes the revenues earned in September by delivering goods and services, and it subtracts out the benefits of costs received in September, the costs that help us earn the revenues. We're matching the expenses against the revenues that they helped to create. We couldn't have created service or sales revenue without expending money for our employees' wages, rent, utilities, insurance, and so on. So net income is a good measure of the success of the day-to-day operating activities for the month of September. Now let's read below the income statement. It states, notice the revenues and expenses on this income statement report the financial impact of the activities in just the current period, just September. Whereas if you recall, when we look at the balance sheet, what we see on the balance sheet, such as cash, equipment, land, all of those things have a financial impact beyond the current period. So balance sheet accounts are considered permanent accounts. What we see on the balance sheet, if you remember, are assets, liabilities, and stockholders' equity. Whereas income statement accounts are considered temporary because they have a benefit in only the current period, or affect only the current period. And our income statement accounts are our revenue and expense accounts. Let's flip to page 2 again. And we've already covered the definition and explanation of revenues and expenses, and we know that net income is not an account, it's a calculation by subtracting expenses from revenues. If revenues are greater than expenses, we have a net income. If expenses are greater than revenues, we call that a net loss. Now below that, we see the time period assumption. This is a very important assumption. It is what allows us to report net income for the month of September or for the year ended December 31st. The assumption states that it allows the long life of a company to be reported in shorter time periods, such as a year or a quarter, which means 3 months, or a month. No business owner wants to wait until his business is closing to find out if he or she has been successful or earned a net income. And the time period assumption allows us to break that long life of a business into shorter periods so that we can report on the success of the business. The last thing for this mini lecture is cash basis accounting. Now I've crossed this out. And the reason is cash basis accounting is not acceptable under GAAP, but I want to explain what it is. In cash basis accounting, it means we're recording revenues only when cash is received and expenses only when cash is paid. Cash basis accounting does not measure financial performance very well when transactions using credit rather than cash take place. It is misleading at best when there are transactions that occur that don't involve cash. For example, if there are purchases or sales on credit, nothing is recorded because no cash is exchanged. So your balance sheet does not show any debts for purchases on credit or any amounts owed to you by your credit customers. Again, it is not acceptable under generally accepted accounting principles. We're going to use the accrual basis of accounting, and we'll be learning about that in our next mini lecture. So you can continue on to watch that one.